Welcome back to the Make Account Podcast.
I'm Marcus Mire, founder of Mire Group CPAs and the Total Control Accounting System.
I'm Tyler Warner, small business owner with a lot of accounting questions. I was about to say tax questions.
Right, but no accounting questions today.
No, tax questions.
Yeah, so today we're talking about how income taxes work, specifically for a married couple.
Okay.
So I want to walk through an example. I've got literally have my tax software up.
Awesome.
Isn't this amazing?
Yeah. What a world we live in.
We're going to walk through a sample situation, and then because here's the background.
All right.
So many people are confused about how taxes work, which I get.
Right.
But specifically about like streams of income and paying taxes on them. Mm-hmm. And then how that also affects when they have a spouse. Okay. So what I want to do is I want to give some basic numbers here that I'm putting into the software. We're going to talk about the output, and then we're going to talk about what it means, like realistically, if you, let's say I got a bonus at work, or let's say I inherited some money, or let's kind of walk through some things. I want to give people some context because people get this wrong a lot and it affects them. Like in terms of like their expectations. Because the worst thing in the tax world from a CPA perspective is your client expecting one thing. Like, I don't owe any money this year. Or I had all these deductions. So, man, my taxable income is going to be lower. And then having to tell them, not so much.
Yeah.
Okay. All right, you ready?
I'm ready.
All right, so we're going to say a husband and wife. They both work.
Okay.
Okay. Husband makes $100,000.
Okay.
W-2 wage earners.
Okay.
Wife makes $140,000.
Nice.
Okay.
Not just 101. Just
140. She's crushing it.
Nice.
They got 2 kids, and I'm gonna keep this very simple.
Okay.
They have a mortgage. They pay $12,000 of mortgage interest. They pay $12,000 of state income tax, like withheld from their paychecks, and they give $4,000 to charity.
Ooh.
All right.
I see I see the twist.
Do you? I think you've done this long enough. You kind of.
I think so. Well, it's interesting that you chose 12, 12, and then added the 4.
Why is that interesting?
Well, because 12 and 12 is 24, which is our standard deduction.
Close. It's close. But yes,
And
there's a reason I did this.
The $4,000 of charity puts us in a quandary. And then I think obviously combined they make $240,000 a year,
right?
Which is a high tax bracket. Mm-hmm. And so they, I'll let you tell.
Let me tease this.
Yeah. I don't want to spoil anything.
Yeah, because you know the outcome.
Yeah.
Okay. All right. So another wrinkle.
All right.
The husband who made $100,000 withheld 18% in federal withholding. So simply stated, when he got his W-2 at the end of the year, it said he withheld $18,000.
Okay.
Okay. The wife who made $140,000 withheld 12%. Ooh. So that means at the end of the year, she got her W-2, she'd withheld $16,800.
Okay.
All right. So let's walk through what the tax return looks like.
All right.
All right. So, like I said, made $240,000 together. Pretty simple. Their itemized deductions. Mortgage interest of 12. The state taxes are 12, but they get limited to 10 because that's the limit. You've heard the SALT cap before. State and local tax, you can only deduct $10,000. That was put in the Tax Cuts and Jobs Act. The Trump tax cuts are what they called. That was the bargaining chip for a lot of the blue states. So they're going to lower these rates. Well, we don't want the millionaires to be able to deduct property taxes on their second home and that sort of thing.
Oh, wow.
Okay, so $10,000. So 12 mortgage interest, 10 state tax. $4,000 charitable. So that's $26,000. The standard deduction for a married couple is $25,900.
Ooh.
Okay. So let's stop. He gave $4,000 to charity.
Our first fork in the road.
First fork in the road. Let's see how good of a student you've been. So total itemized deductions are $26,000, but the standard deduction is $25,900 for a married couple. Mm-hmm. How much benefit did they get from the charitable?
$1,000.
$100.
Oh, okay.
The difference between
you said $25,900.
Yeah, $25,900.
I was still thinking. Yeah. Okay.
So first thing I want to
$100.
give people an example of. You think, I gave some money to charity this year. Didn't really save you anything. Mm-hmm. In this example, so
it helped somebody.
Yeah,
but it didn't really help your taxes.
But expectations wise, again, while you want somebody to coach you on this or to tell you, or hey, I'm giving a bunch of money to charity. I think as a taxpayer, this is going to really help me.
Yeah.
Let's take it even further. Let's say your mortgage was $10,000. So 10 grand state taxes, 10 grand mortgage, 4 grand charitable. Now your charitable literally has done nothing because your itemized deductions are 24 grand and the standard deduction is 25.9, meaning you were going to get a $25,900 deduction regardless if you gave any money to charity. Okay, so that's the first thing I want to bring up. Okay, 240 wages, 26,000 itemized. Taxable income is 214. Sorry, all right, 214. Our tax is $39,031, and we withheld $34,800. So let me back up. I said they had 2 kids. Scratch that because I didn't put them in the software.
Oof.
I know.
Okay.
We just nixed the
Little
kids.
Johnny and Susie are, yeah.
They're done.
Yeah.
Maybe let's assume they've graduated college. They're off the payroll.
Yeah.
All right. Okay. So they owe $4,246. Point here, they have a $15 estimated tax penalty.
All right. So let's rewind. All right.
Yep.
So they owe how much in taxes?
4246. Like,
And
what's
they-
let's walk through the terms. Total tax is $39,031.
Okay. And they've already paid
34,800 through withholding.
from like,
So let's just set the terms. We had taxable income of 214. We have total tax 3931. We had total tax payments, which for them is withholding, of 34,800. All told, they owe 4246.
okay.
Okay. So here's one thing I wanted to mention. I'm going to go and look at here. So you'll hear people talk about income tax brackets a lot. But one thing you should be thinking is, what is my effective tax rate? Because just to give a little backdrop, when you pay income taxes, you get to pay them at graduated rates, right? You move through the income tax brackets. What that means is you pay some income tax at 10%, some at 12, some at 22, some at 24. And a common misconception people they say is, I'm in the 24% tax bracket, therefore all my income is taxed at 24%. So I can tell you, this particular client who is in the 24% income tax bracket, their effective tax rate is 18%. So that's making the point that they've paid taxes at lower rates for it to average out to be 18%.
Okay.
Otherwise, it'd be 24, right? We would say, take your taxable income, multiply it by 24%, there's your tax. But that's not how it works. The rates work like this. For a married couple, first $20,550 is taxed at 10%. I'm going to round here. Mm-hmm. The next roughly $60,000 is taxed at 12. Then the next looks like about almost $195,000 is taxed at 22%. Then the next, and this is where they come in, the 24% bracket. Then there's a big bracket of about 140 plus 122. What's that? 26. That would be 140 plus 22, about 166,000 taxed at 24. That's the most that can be taxed at 24%. So my point is, your marginal income tax rate is just the tax you'd pay on the next dollar.
Right.
So for this couple, they are firmly in the 24% bracket. Their income was $214 taxable. The 24% bracket starts at $178,000 of taxable income and ends at $340. So for them, they've got a while. Every dollar they add would be at 24%. But the whole thing is 18%. Why? Because you get the benefits of the smaller rates. You get to work through them. Okay. Here's kind of what I wanted to show you. So I'm going to go back to my little deal here.
And so your software just runs that, like you just type in the total, it breaks all that down, and then gives you the effective tax rate. But either way, you're seeing the total.
We could go. I mean, and there's obviously a million caveats to this. If you had capital gains, which I didn't throw in, and qualified dividends, but I could go do this by hand, and the total would be that number rounded. It'd be the $39,031. So this is what I also hear from people. So I would presume in this example, both taxpayers think they've probably paid their taxes, right?
Sure.
It was withheld from them. But you and I both know they owe $4,200. How is that? Well, it's because if you think about it, the taxes were an 18% effective rate. The husband withheld at an 18% rate. So you could say he effectively paid the taxes on his income, but the wife didn't. Her taxes were withheld at a 12% rate. So there's kind of your gap.
And she made more.
And she made more. So it's even exacerbated. So now we've got 140 grand of taxable of income that has a 6% deficit on it. So if you just did the math, 140 times 6%, it's probably $4,200. That's where the. But my point in saying this is, people think when they get their W-2s that the taxes are paid. It just goes into the pot to determine taxable income, to apply the tax rates, and then they say, okay, after we've applied the tax rates, here's your total tax. What'd you pay in? From both of you. Let me give you another example. Let's say husband got a big bonus, and he continues to withhold at 18%. Would that add or reduce the amount they currently owe? So if we just, let's say he got not 100, I'll make the math easy, a $10,000 bonus, and he withheld $1,800. Is that going to add or subtract from the amount they owe right now?
Oh, it would subtract.
It would add, because they're in the 24% bracket. So every dollar of income they add is taxed at 24%.
Oh,
So in that example, $8,600.
Oh, yeah. I was thinking, okay.
So again, the reason I'm telling you that is because you've got to understand.
I failed most of these.
You do. That's okay. But that's why we have you.
And you keep asking.
Yeah, that's fine. That's why we have you. My point is, that's why you need to know two things. Effective tax rate tells you kind of how you're doing, but marginal tax rate tells you for the what ifs. What if we make $100,000 in this business deal? What if we pull $20,000 out of an IRA? What if I get a $20,000 bonus? It's the marginal dollars. Because I see this all the time. I'll give you another example. And I hear people that literally say this. Well, I inherited an IRA and I took a withdrawal from it. I took $50,000. But the IRA custodian, think Fidelity, Schwab, John Hancock, they withheld money from me. I already paid my taxes on that. I've heard that term before. Let's walk through the scenario. Say it was $50,000 and you withheld 20%. That's 10 grand, right? It should be at 24%. What's 24%? 12 grand on 50?
Dude.
Yeah, it is. Just double it. It'd be 24,000.
Yeah.
Okay. So if you in your mind come to your CPA and say, and he goes, oh, I noticed you took some money out of IRA. Oh, but don't worry about that. They withheld the tax. I already paid the taxes on that. How do you know you've paid the taxes on it? You've had money withheld from it, but that doesn't necessarily cover your tax bill because why? You don't know what your tax bill is because you haven't factored in all the factors. What'd your husband make? Or what'd your wife make? What did they withhold? What did you withhold? So I want to give people that, I hear that term a lot. And in that example, you'd owe $2 grand. You have no clue.
Yeah, I think the simple thing to understand is that, like you said, you're just putting money in the tax pot.
That's a good point.
But you don't know, anytime somebody withholds anything, whether it's your employer or your IRA custodian or whatever, like that's just money in the tax pot, and you don't know what how big the pot is until you get
all the ingredients.
All the ingredients. I was going to bail from the analogy.
No, I like that. I was following.
But I was going to use the actual term. Is it adjusted gross income?
Correct.
So until you know, and that's what you're trying to figure out.
And then taxable income, so adjusted gross income would be all your income and deductions, not including the standard or itemized. Okay. You get to adjusted gross income, then you take the greater of standard or itemized as taxable.
So that's what you're saying.
Correct.
Is like, okay, yes, you put money in the pot, but you don't know the final, dimensions of the pot.
That's right. So, because what I want to try to articulate, and maybe I don't.
And that's the tough part, I would say, because like there's like, well, I think the pot's this big, and I've overflowed it with tax money.
Of course.
And you're like, I don't know, but we got to figure it out. And then it could
absolutely
be good, it could be bad. You just have to do that work.
Well, how about this? How about you have a husband or a wife who you don't realize is under withholding? So you're like, yeah, I'm good. I withheld at a high rate.
Yeah.
But as a couple, you didn't.
Right.
And how do you know that? Well, you don't know that until you put it all together. To your point, till you get the pot. Like everything, you get what the income is at a couple level. And so what I want people to just realize is, taxes aren't in a vacuum. Like a one transaction, the IRA is a good one because it's like a one-time thing, right? Like I got an IRA and I withdrew money from it. And we're not even talking about the early withdrawal penalty, like that notwithstanding. Very simple example. But what I want you to leave this conversation with is, did you pay your taxes? Maybe. It's not that thing had to carry a tax burden and it's paid. It's that thing is taxable income and they withheld from me that contributes to my tax payments at the end of the year. To your point, perfect point. It just went in the pot of all my taxable income and all my payments. And so I hear that term a lot, and then people start to either just, and then what I want also people to get is, if you want to not be surprised, I think I said that right. If you don't want to be surprised, what did I say? You want to not be surprised? Yeah.
I don't know.
If you don't want to be surprised, you need to have somebody that can take in all those things, all those pieces into consideration. Otherwise, you're short-sighted. If I just tell you, yes, you should withhold 24% because that's your marginal rate. What I'm not considering is what your spouse did or didn't do. So you may think, oh, I'm good. They told me 24%. I'm good. I didn't even have to tell him about the rest of the game. But the rest of the game factors into this. So I just want people to get that idea of like, hey, and kind of like I told you a minute ago, if you did a 50,000 and you only withheld 20% and your margin rate's 24, you don't even know you have a $2,000 deficit. So you need somebody to put those pieces together, run a calculation, kind of show you how it works.
Yeah. Okay. Well, I think I think it brought some clarity there.
Yeah. Yeah, I'm kind of looking at my notes, but that was the things I want to talk about. Effective rate, so people just get an idea of like, no. Oh, another kind of myth to dispel. Let's just say this couple was close to the 32% bracket, which I think was at around 340. Let's just say, because I hear this too. I know you've heard this. Hey, should I make a little bit more money? Like I have a chance that my employer will pay me this bonus, but I can tell them to pay it on January 3rd because it won't put me in another tax bracket. And while I understand what they're saying, they're thinking this now makes every dollar I've earned taxed at 32%.
Yeah.
And it doesn't. It just makes, in that example, if that made your taxable income go to 350, it puts that 10 grand, the amount over the 340 at 32%.
Well, and you could potentially be creating a scenario that's worse, right? Because then next year you'd have two bonuses in the same year, which would actually be taxed higher, right?
Yeah, that's a great point, because this year you could say, well, only 10 grand's going to be at 35% or 32.
Yeah,
but
and
next year it might be 20,
50, or
60.
whatever.
Yeah, but again, back to the point of, what if you had a tax advisor who could just tell you that? Who could be like, ooh, I don't know if that's a great move. First of all, let me tell you where your thinking's not right. Not every dollar's taxed at 32%, just this little small excess.
Yeah. All right, I'm gonna I think we've made that clear. I'm gonna ask you a couple of questions just about the future of accounting, and because this is where my mind goes. Every time I hear things like that, this is what I'm stuck with.
Yep.
It seems like it's all math and information, and those things are increasingly coming together, like we talk about all the time, but there still seems to be a gap of like, well, it's like, okay, Zero and all these software pieces, like we just talked about no code and how sophisticated and triggers everything and all these actions and stuff. But yet we still come back to like, well, if you have a CPA who knows all this information, then they can figure it out.
I'm glad you're asking this, by the way.
Where are we going with like, because in my mind it seems like, big cloud pictures, like, man, it seems like software can know that. And
with the right variables, yes. With the right variables, yes.
Do you see that gap closing?
I do. I think I'm going to take a different approach to it. I think it's closing on you've asked this question before, which I think is a really good question. You probably don't remember this. I want you, if I'm a business owner, I need you to tell me of every dollar of revenue I make, how much is that ultimately going to cost me tax? That, I think, is a really good question. I think that's going to get answered. Again, hard to say, because how does the software... there's lots of errors, but I do think, and I'm not going to be like, how does the software know? It's going to get better. But that is going to get answered over time through data. Yeah. If the software starts to see that for every dollar you make, you have 20 cents of expenses, it's pretty easy. And that's been the case for the last 7 years. that's going to be in that calculation.
Yeah.
Where they're going to say, then Tyler, okay, then we then should say, oh, you should withhold 12% of every dollar of sales, put it away. That's going to be your tax liability.
Yeah, I mean, it seems like that's the trajectory of things, but I'm just wondering your perspective because, like, I see that in other software, like just even like marketing technology. Like, there's some sophisticated stuff of like, hey, we think you should run an ad like this or during this time. Even as simple as like MailChimp will say like, hey, send it during this time versus that time. Like where there's this like forecast knowledge that is based on like your specific circumstances. You know what I mean? And it's like distilling all that information into a recommendation. Yeah. And that's where I just feel like I haven't seen, it's like, you talk to an accountant, it's like, yeah, you've got the software, you plug it in. Right. You know what I mean? And then there's like personal tools like Xero and things, but there's not a...
Nothing I know, but I mean, I don't think it'd be far-fetched down the road. I mean, just yesterday, I think it was, or 2 days ago, you know, when ChatGPT 4 came out, one of the things they did was they fed it data and it told them what their taxable income would be. Yeah. Like, so that's happening.
So there we are.
Oh, yeah. ChatGPT basically, and it was to the penny right. It was, they made 120 grand. They, basically what I did, they withheld 20,000. What's their taxable income? What do they owe? Bam. Done. Wow. And it was right.
Well, there we go.
Yeah. So to answer your question, that's it.
Yeah.
No, it's going to come. It's going to be sophisticated. I do think like lots of CPA firms, like the real super progressive ones are already plugging ChatGPT into their tech stack in terms of how they respond to emails, like knowledge-based kind of questions like, hey, ChatGPT, respond to this email with a, you know, positive tone. And it's like, you know, like they're doing that kind of stuff already. They're going to start. Another prompt I saw a guy did, he said, hey, client has these 30 transactions with these vendors. We don't know what they're for. Run these vendors. Tell me what their category would be. It was like office supplies and janitorial and like it knew just for a quick Google search. So yes, I think that stuff's happening. That's going to happen. How it will work, I don't know, but you're already seeing the seeds of it.
Yeah. Wow. All right.
All right.
Till next time then. Yeah. But until then, as always, go to Mire Group. Check out the other podcasts. There's a lot of helpful ones in there in the list that we've done. We're like in the 70s now.
Yeah, so that's a pretty good milestone, I will say.
Yeah, lots of good content. Yep. And that's coming from us. You know, totally unbiased. Right. So check that out, Mire Group. You can reach out to the Mire Group there as well. Until next time.
All right, guys. See ya.